for attending today's webinar, where we'll be covering diversification of your portfolios and opportunities in China and Hong Kong. So before we get started, just a little disclaimer. Anything said here will solely be for education purpose only and does not constitute to any form of financial advice. So let's start with introducing our company, CGS-CIMB, and our new Prosperous platform. So Prosperous is actually a digital investment service launched this March that is built by millennials, for millennials, and everyone else in mind. We aim to provide you with the best in-class services when investing online. And as part of our education efforts, we have specifically curated series like webinars hosted by investment gurus such as myself so that anyone can gain more insights on investing responsibly over the long term. We also share bite-sized investment insights on our website, social media accounts, and dedicated Telegram channels. With that, let's start the webinar in proper. Okay, so to start the webinar in proper, I would like to ask everybody, when you invest, what diversification methods do you actually look at? Because we all know that we do not put all our eggs on one basket and we tend to diversify, be it geographically or in terms of different investment classes. So what do everybody look at? Different people have different matrices they look at, but personally, I think that it boils back down to 4 key factors. Firstly, is it growth? Or are you looking at stability? Lastly, are you looking at towards whether you're looking towards the future economy to future-proof your portfolio, or you're looking at a market leader? So different people rank the factors differently, but I'm sure deep down in your heart, you know which is most important to you. So with that, we're actually touching on the Chinese markets, because on Chinese markets, it actually tend to fulfill some of the criteria of those 4 factors. So we are looking at Chinese markets, we tend to look at the China policy. China, unlike many countries, tend to develop 5-year policies, because with these 5-year policies in mind, they are working towards it, and then after that, try to cover all these goals in the 5 years. So the latest 14th 5-year plan was actually announced earlier this year. So what is very important out of these 5 factors is actually the 2 that is highlighted, namely the domestic circulation as well as the foreign participation. Why are these 2 important? It's because it shows that China is actually opening up its financial markets. It's trying to get more investors to invest in China itself. So they are not only trying to allow more dual circulated currencies, they are also trying to make it easier for foreigners to invest in China. And we can see it via the various Stock Connect schemes announced this year itself. So we can see that since A shares became available for foreigners to invest in year 2002, there are various mechanisms in place to make Chinese markets more and more accessible to everybody. So we can see not only are the various mechanisms introduced as shown in the slides, right now, most recently, the Bond Connect as well as the Wealth Connect, which was fully launched this year, enables people who are not based in China to buy Chinese products easily. And with that, going forth, it can become easier and easier for people to invest in China, and it may make Chinese markets more attractive. So when we look at Chinese markets are actually separated into 2 different types of markets, the onshore market and the offshore market. So when we're looking at onshore markets, we are actually referring to investing into Chinese equities itself. Meaning to say, you are buying off the Shanghai Stock Exchange or the Shenzhen Stock Exchange. Whereas when you're looking at offshore markets, you're looking at maybe Chinese equities listed on the Hang Seng in Hong Kong itself, or on various US exchanges, like example the Nasdaq or NYSE. So what's the main difference between both of them? Well, for onshore markets itself, we can see that it actually has the largest number of companies actually listed on it. So there are many different state-owned enterprises or actually mid-cap companies that you may not find it on offshore markets. Whereas for offshore markets, it's more of the tech names as well as the bigger companies, things like your Alibaba, etc., or Tencent, which we may find it listed in Hong Kong or in US. Okay, so how about other things that onshore markets are good for? Onshore markets has actually a lot of unique sectors. So I'll actually cover them quite in depth later, but some of the unique sectors they may offer are things like your Baijiu, your Guizhou Maotai, which may not be accessible via other markets. So when offshore markets, they are more globally recognized names. What's good about onshore? Onshore actually is has the support of state-backed funds. Because why? When the Chinese government actually wants to support the markets, they will support the onshore markets first. Whereas you can see offshore markets, there are more and more restrictions in place due to the regulatory risks, and this has actually caused some sort of like dampening of offshore markets. Whereas if you see onshore markets are mainly very retail driven, because about 80% of the trading volume is actually generated by retail. Whereas for offshore markets, they are more institutional based. So, as stated, Chinese equities, especially offshore equities, are more likely to face headwinds in the US because of the increased regulatory risks, as well as the increased requirements by the SEC to actually control these Chinese companies from listing. So because of that, it can be more advisable or sort of like better to look at onshore markets because there's less risk involved. We can also see that Chinese cyberspace regulators have also laid out main conditions for companies wanting to go public in US, for example. And so onshore markets can be better markets if you are looking towards investing in China. So what are the ideal markets to invest in Chinese stocks? Mainly, we are looking at two main markets, China and Hong Kong. Even though Hong Kong is an offshore market, it still presents a better investment opportunity right now as compared to Chinese listed equities in the US. And I'll explain why. So if you're looking at investing in China itself, the pros for investing in China is a direct investment. So you are sort of like eliminating a lot of cross-border risks. Also, there's a wider array of sectors to look at, and you are looking at more localized companies. As stated just now, there's also state-backed fund support, and there's growing foreign interest towards it. However, the not so good things that people may be looking at is that investors are very unfamiliar with it, and there's limited choices because you can only go through the Stock Connect. So not all the stocks are available on the Stock Connect, but nonetheless, it's still very sufficient. Whereas why I look at the Hong Kong markets is because Hong Kong markets is actually a proxy to invest in China markets. So by investing in Hong Kong, a lot of the companies listed in Hong Kong actually has China exposure and get their main source of revenue from China itself. It also houses many prominent Chinese names, like example your Alibaba, your Meituan, your Xiaomi, Tencent, etc. It's also more internationalized because they have internationalized business in terms of these bigger scaled companies. And it has many ETFs. So ETFs can be something to look at because ETFs enables you to buy both into Hong Kong listed as well as it can track Chinese equities as well because there are many China listed ETFs in Hong Kong. Lastly, we can see that it's exempted the stricter IPO rules because right now what happens is that when the Chinese government is actually tightening down, it's actually tightening down on US listings, but not so much on Hong Kong listings. However, the con here is that it has a unique geopolitical situation, whereby we all know that it is quite unique in the political sense of things. So why is Hong Kong seen as a proxy to China? As seen from here, over 50% of the HSI constituent stocks are actually China-based. So we can see that most of the Hong Kong domiciled companies have China links. And if we look at the table towards the right-hand side, all those with highlighted in red are actually component stocks with China exposure. So their main business is actually in China. Things like your AI, things like example your China Mobile or your China Mengniu, etc. Also, it's often used to tap into China is because some of the Chinese equities can be less accessible and Hong Kong markets is more accessible. So people tend to use Hong Kong as a proxy to China. And when looking to invest in China, people not only look at China markets as a whole, they can also look at Hong Kong listed Chinese equities. So we can see that this is very similar in terms of the performance as well. And I'm going to show you what exactly happens. If you look at the A50 index, notice the different peaks and the bottoms. And if you look at the various scenarios, you can see that it's very similar to that of the Hang Seng markets as well, whereby they are impacted by very similar events and the drawdowns as well as rise is also very similar. And we can see that for the Hang Seng, rise is also generally more volatile in terms of price and more impacted by China-related events. So it shows the the correlation between both markets. And naturally, you will tend to look at Hong Kong markets as one to invest into China as well. So we can see that both Hong Kong and China markets are very huge in terms of market capitalization. And China is ranked second globally, while Hong Kong is ranked fourth globally. Aside from that, we can see that liquidity in Hong Kong and China are also very high. So you can see that for liquidity in Chinese markets is much higher than that of US markets, and for Hong Kong markets is definitely much higher than that of the Singapore market. So we can see that if we are looking at investment into both, we do not need to be very afraid of liquidity risks. So we can see that China has good prospects going forth because the global investment interest in China is actually increasing. So we can see that there has been exponential growth, all right, observed, whereby foreign funds are actually investing into China A shares. So we can see a 62% year-on-year increase into A shares from fourth quarter last year itself. Also, we can see that foreign interest has been holding a high percentage in terms of market cap for A shares over the past 5 years. So if you look at the graph at the bottom right hand side, you can see the foreign stock holdings in A shares have been growing exponentially. So this is all very positive signs that people are more and more interested in Chinese markets and looking towards investments into it. We can see that inflow into Hong Kong is also growing. All right, this is via the Stock Connect, whereby Chinese markets are interested in Hong Kong markets as well, as in the Chinese citizens are interested in Hong Kong markets, and because of that, they have been actually investing into it slowly, and there has been an exponential increase as well. So we can see that southbound holdings as a percentage of market cap have been increasing exponentially over the past 2 years. So why invest into both countries? Well, because growth in China market actually remains, and it produces a lot of diversification benefits. Lastly, it consists of various unique sectors, which I will share with you, and it may actually catch your interest in that. So growth actually remains favorable despite all the negative news that may be happening online, whereby people are actually worried about the regulatory risks. Many official organizations have actually stated that Chinese growth still remains apparent, and they are actually confident that China is going to recover going forth as well. So not only has the World Bank lifted its view on China, we can see that China's growth is still the strongest among its peers as well. So you can see that as compared to the other nations, China's year-on-year growth in terms of GDP is still sustaining substantially and produces growth going forth as well. China is also opening up, as shared earlier, in terms of its 5-year plan, and we can see that China markets have generally outperformed the world index. So going forth, as it reopens more, it's going to actually garner more interest, and with more various funds adding Chinese equities into their portfolio as well, we can see that there will be a general uptick in terms of interest. Interestingly to note, despite the recent fall, we can see that the Chinese markets have still outperformed the world index, as seen in the graph here. So, why invest into China? Is because it produces diversification benefits as well. We can see that there's a low correlation between A shares and global indices, as well as the same for Hong Kong shares and global indices as well. So if you are looking at diversification, because we all know that we don't want to have a too concentrated portfolio, we can definitely look at Hong Kong as well as China markets to actually diversify from our usual Singapore or US equities itself. So, time to touch a little bit about the interesting sectors of the various markets. So I'll start off with the A share side to show you some of the interesting sectors which you may look at. The most interesting one is actually the baijiu sector, whereby it is not investable elsewhere. So baijiu is actually an alcohol that is unique, and it's one of the most major distilled alcohols around. So what happens is that we can see that the baijiu interest is actually gaining more traction over the years. And if you look at the duty-free stores in Singapore, for example, you will see baijiu on the shelves, and some of the times it's very easily sold out. So because of that, it actually attributes to 1/3 of the global distilled spirits overseas. And by looking at baijiu itself, we can definitely look at the different companies that produce baijiu. And the most prominent one is Guizhou Maotai, and you have things like your Wuliang Ye and Luzhou Laojiang. So if you are looking at this kind of investing into alcohol and you're looking at the growth potential of the future demand towards the baijiu sector, this can be interesting to look at. And these companies actually presents investment opportunities. The next one is the rare earth sector. So the rare earth sector is something we all know that China is actually one of the huge producers of rare earth. So what happens is that more than 85% of the world's rare earth is actually produced in China. And why is rare earth so important? It's because these scarce minerals are actually used in various technology. And the most easiest to correlate to is things like your lithium, which is linked to your electric vehicle batteries, as well as your smartphones, because your smartphone batteries are also created by lithium. So some of the stocks we can actually look at are like your Kangfeng Lithium, which actually recently signed an agreement with Tesla to actually produce some of these batteries. And you can have your other sort of like other battery providers, such as your Shanghai Putalai, as well as your Zhejiang Cobalt. Last sector of the Chinese markets, which is very interesting, is actually the agricultural sector. So the agricultural sector is something we don't often see in Singapore or even in the US. It's because China, end of the day, is still an agricultural state in some of the more province area. So you can see that not only does it produce poultry, it also produces other meat-related products such as pork, etc. Because of that, it's actually one of the growing sectors over there, and people are looking at it because right now, if we look, recently China actually announced that it's going to focus more and more about food sustainability. Recently, we see a lot of ESG related themes ongoing, whereby people are looking at proper sustaining of food to ensure that the food supply in the world remains sufficient. So because of that, agricultural stocks or livestock stocks are actually more closely looked at by people nowadays. And some of the examples of the various counters include China Animal Husbandry, as well as Wuhan Kejian Biology. For Hong Kong markets, I think this is the sector that everybody of you all know, technology sector in Hong Kong. So the technology sector in Hong Kong is very unique because it's slightly different from that in the US. It's targeted more towards the Chinese audience. And then we can see that it's also targeting global audience is growing, but it's at a different wavelength as that of the US. So some of the more Chinese technology sectors that have been in the spotlight of late is because of the regulatory risks that people are actually looking towards it. But bear in mind that there's also the antitrust situation ongoing in the US as well. So I mean as in people are just looking at the situation in two separate lights, that's all. So some of the stocks that people are looking at the technology sector, I think are your 4 big tech stocks in Hong Kong, namely Alibaba, Tencent, Meituan, and Xiaomi. Some other unique sectors is actually the sports equipment sector. So this is actually very interesting to look at because people are looking towards the recent Xinjiang incident, whereby the Xinjiang cotton incident has actually resulted in many of the Chinese citizens to boycott foreign brands like your Nike and Adidas. And this actually caused them to look towards more of the local brands. And there's a growing popularity, especially among the younger Chinese, to actually have this China chic fashion. This China chic fashion enables them to embrace local brands. And because of that, the benefits from nationalism in China itself is actually causing ANTA and Li-Ning to actually grow exponentially in terms of sales as well. And it's also gaining more sort of like foreign recognition. And you can see that other countries are also using ANTA and Li-Ning. In the most recent Olympics, you can see that other countries are also using these different sports brands as well. Other unique sectors include the technology equipment. We all know that technology, at the end of the day, requires hardware as well. And although we do know things like your Apple smartphone, we do know your Samsung smartphone, etc., we must actually look behind the chips as well as the camera modules that form these different smartphones. And because of that, actually a lot of these chip makers as well as camera module makers come from Chinese companies, and they are listed in Hong Kong. So some of these companies we can look at is like Sunny Optical, which actually produces camera modules for iPhones, and Q Technology, which produces camera modules for Samsung itself. Aside from that, we must note that China is actually pushing this semiconductor industry because they want, right now we have this semiconductor crunch, and they're actually pushing for more local companies to fill this void. Because of that, there's more upside potential in this aspect, and we can look closely at it, especially the camera module companies, because they are also venturing into electric vehicle camera modules, and because of that, it can present an upside potential going forth. All right, and then I think this sector is also very unique. Many people have heard of it, but may not have the confidence to go into it. It's actually the gaming sector. So the gaming sector, in terms of the Macau gaming, actually forms a bulk of Macau's economy, and it's actually something people really look at. But however, recently there's some drawdowns because of the fact we see COVID and tourism is affected. We can also see that they are implementing new rules in place to actually control the sector as well. But nonetheless, some of the more prominent gaming stocks will include Galaxy Entertainment, Sands China, Wing Macau, etc. The last sector I'll be talking about is actually one of the up-and-coming sectors. We all know Tesla in the US, but why not look at China automobiles as well? So the electric vehicle market in China is actually growing, and some of y'all may know companies like BYD, companies like Geely Motors or XPeng, NIO, etc. So what happens is that, in case you don't know, BYD is actually producing the electric bus we see in Singapore even. So with that, it actually shows that various countries are also adopting this different kind of vehicles, and with the green push, the ESG push going forth, we may be looking towards more electric vehicles going forth as well. So I'll just touch a little bit about some of the recent developments in China and some of the takeaways you may look at it in terms of whether or not to invest in Chinese markets. So we can see that in the long run, I actually differentiate it into positive factors and negative factors. The positive factors is that the measures in place is actually focused on China having sustainable growth going forth. And with that in mind, we were looking towards maybe short-term pain, but long-term gains. So we can see that the increased regulation in China is actually going to help China in terms of internationalization efforts, whereby you can see that it is actually trying to become more internationalized so that people will feel that there are certain standards governing it, and that's why it's tightening the measures. Second, the anti-monopoly laws in place is actually going to level the playing field for SMEs. So it's going to help SMEs grow, and maybe we will see the next Tesla or the next BYD growing from these SMEs. So it's actually to ensure that the bigger companies do not kill the smaller companies or eliminate the ongoing competition. Lastly, even though a lot of people are very anti-common prosperity, we can see common prosperity is due to improve the sort of like the national geographics in China in the long run. So it's actually very prominent in many different countries as well. It's just that people do not so openly state something like common prosperity. But if we look at other countries, it's also there. However, what's the negative? The negative is that we all can't take the short-term volatility. We all can't take sudden changes. So the sudden regulatory changes actually spark much market uncertainty, and because of that, it sort of like it causes fear in markets that the short-term profit earnings is going to be affected, and because of that, people start selling the relevant equities first. Also, it could result in more companies becoming sort of like partially state-owned, as you can see that Alibaba, in terms of its payment unit, has actually become partially state-owned. So people are worried about that as well. Lastly, is that the reforms could actually result in lesser M&A in the near term. However, if we look beyond these near-term factors, in the long run, it's still looking quite positive. So lastly, I'll just explain to you what's the difference between Hong Kong shares as well as China shares. So H shares, it refers to China shares that are listed in both Hong Kong and China itself. So of course, they are subjected to different rulings by both exchanges. Aside from noting that the currency traded is different, the trading lots and minimum lot size are different, we must actually note in terms of the settlement. So what actually people are looking at the end of the day is in terms of the market conditions. So market conditions, I'll just repeat another time. which I stated at the start, which is for the H shares itself, there are more institutional players over there. They attribute to around 50 to 60%. Whereas if you're looking at A shares has more retail players. So you're looking at 70 to 80% of the market volume is traded by retail. So with that, A shares technically tend to be more volatile. Also, if you look at A shares, they're looking more towards the concept and thematic plays, whereas for H shares itself, you're looking more towards long-term and value plays. And if you compare A shares and H shares in the same stocks, for example, like Bank of China, you'll see that the PE value of A shares is much greater than H shares. But there's a reason behind it. It's because the dividend policy, as well as the rules governing the respective stocks, is slightly different. And that's why there's a difference in valuations. And we cannot definitely use that as a form of arbitrage. So, after speaking so much, I'm sure you are interested to see how can we invest in the various Hong Kong and Chinese markets. So investing in Hong Kong markets is quite easy. You can just invest directly. There are two ways to actually invest into it, either via equities or via ETFs. So equities, if you want to invest into the stock directly itself, you're actually owning a part of the company. But with that in mind, you have to, because you're only owning one particular company, there is more concentration risk in that sense. If you're unfamiliar with the market, people tend to look at ETFs, exchange traded funds, which give you an array of products, an array of companies inside the ETF because it tracks particular indices. And because of that, there's more diversification benefits as well. So different products suit your different needs. And if you want to trade equities, you can definitely do so. For Hong Kong markets, you can just trade on your various platforms, like example, Prosperous. Or if you want to trade Hong Kong markets, you want to trade China markets, you can do so the same. But it's just that China markets have to go through the Stock Connect. So for those who are interested in ETFs, I've actually listed out the different ETFs available. Not only are there ETFs that actually track the Hang Seng Index, there are also those that track the Hang Seng Tech Index and the various Chinese indices, like example, the A50 or the CSI 300. So all of these are tradable on the Hong Kong Exchange, and the Hong Kong Exchange listed ETFs actually provide more liquidity in that aspect. So that's all from me for today. I hope you have enjoyed and learned something new from this session. I would just like to add on that at Prosperous, we are always coming up with new account opening promotions, so please follow us on our social media accounts and check out our website for more details. If there's anything I've shared earlier that may have caught your eye, do sign up for an account today or request for a free demo account on our website if you are not ready to take the plunge. If you are interested to find out more about investing or Prosperous, do drop us a DM on Instagram or drop us an email at hello@prosperous.asia. We are always here to help. With that, thank you.